Ryan Reynolds here from Mint Mobile with a message for everyone paying big wireless way too much. Please, for the love of everything good in this world, stop. With Mint, you can get premium wireless for just $15 a month. Of course, if you enjoy overpaying, no judgments, but that's weird. Okay, one judgment. Anyway, give it a try at mintmobile.com/switch.
Upfront payment of $45 for 3-month plan, equivalent to $15 per month required. Intro rate first 3 months only. Then full price plan options available. Taxes and fees extra. See full terms at mintmobile.com.
Reality radio for a really great future. We're talking real money.
Welcome to another short edition of Talking Real Money Daily. I'm Don McDonald. Today's edition is also short for two reasons. One, because we don't have any calls. If you have a question that can be answered on the podcast, leave that question at 855-935-TALK, 855-935-8255, 24 hours a day, 7 days a week, or you can submit a question at talkingrealmoney.com, the all-purpose and becoming even more all-purpose website for anything money-oriented, particularly investment-oriented. Call 855-935-TALK or go to talkingrealmoney.com, leave a question. I'll use it in a future podcast, but this works out really well because I have a convention to attend again today. So, for 3 days. So, today, real quick, I want to talk about something. It was an ad. An ad. Even insurance companies, even life insurance companies, don't like fixed indexed annuities or equity indexed annuities. New York Life is running an ad in one of the advisory publications. And the headline of the advertorial is, "Are investors leaving gains on the table?" They're offering a white paper that explores a new pre-retirement solution that may offer more growth than fixed indexed annuities, they say, while providing similar downside protection. What it is, it's an old-fashioned variable annuity. An indexed annuity is an annuity with a kicker attached to it. It'll give you the return of an index like the S&P 500, or at least they claim to, while keeping you from losing anything on the downside. But the reality is it's not the return of the index. It's based on the movement of the index like the S&P 500, but they have a cap and they have a maximum percentage of the return you can get, and you don't get dividends, and it ends up being about 3 or 4% a year. That's really what it ends up being in reality. Well, they have their latest white paper that provides an analysis of accumulation phases, I'm quoting from it, of a new solution. It's a variable annuity with what's called an accumulation benefit rider. It's another little thing you can attach to the policy that says, okay, you get back, if it's gone up this much, you can't go below that much. So I looked up some of New York Life's variable annuities and their riders like this rider to see what that added protection costs you. Well, here's the biggest problem with variable annuities right off the bat. Just the variable annuity part, the mortality and expenses portion of their insurance policies can run as high as 1.6% per year. Just that. Then you have to add in the expenses of the mutual funds they use, and most of the mutual funds they use are high-fee mutual funds from active managers, and those are in the 0.7% range. They can be higher or a little lower, but that's about right. So right now we're looking at a little over 2%, about 2.25%. But what about this accumulation benefit rider? Well, apparently those things can run an additional 1.5%. So now we're over 3% and we're pushing 4%. Wow. What does that leave you? Well, let's assume the market returns an average of 8% per year over the next 10 or 15 years. What does that leave you? Well, that leaves you with about 4% a year. Maybe 4.5%. They eat up so much in fees, you can't make money on these things. They are bad deals for you, the client, They're good deals for the New York Life salespeople, though, and New York Life, because they get big fat fees. They make almost as much money as you do without any risk whatsoever. And flip it over, the agents make 8%. Why? Well, I checked the surrender charge. 8% the first year. The surrender charge and the commission received by the agent are usually very close to each other. In fact, often they're the same exact number. So the agent makes out like a bandit, the insurance company makes out like a bandit, and you get the returns of bonds, maybe a little more, with some risk, and you're making everybody else rich along the way. I think you should build a portfolio that is designed for your risk tolerance, that has incredibly low fees, and maybe puts most of the money in your pocket. Doesn't that sound like a much better way? If you have a question, give me a call, 855-935-TALK, 855-935-8255. It's free and it's really easy. And if you need any kind of help with your money, visit us at talkingrealmoney.com. There are links to almost everything interesting in the world, or at least interestingly honorable in the world, and it's free and easy. TalkingRealMoney.com. You can leave a question there, too, or call 855-935-TALK. Thanks for listening. Please subscribe to the podcast through one of your favorite podcast services, preferably Apple Podcasts or iTunes, because they're the biggest. And we'll talk to you again next week. Take good care. I'm Don McDonald.
Talking Real Money. We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. That should keep the lawyers happy.